Okay, we're recording the second half now. And Matteo Salinas is somebody who's still in school, but has nonetheless already the experience of many and by far the majority, I think, of traders, and that he's writing blogs already, and he's got a whole bunch of certifications. But I'll let Matteo introduce himself. So please take it away.
Hello, my name is Matteo Salinas. I go to NC State, and I will be talking about technical analysis and options trading. Let's see. Okay. So I want to put a disclaimer out. This presentation is for informational purposes only. Do not go out and make $1,000 trades based on what I'm going to say. This is for information and entertainment purposes only. So who am I? I am a senior at NC State, majoring in statistics. At 19, I completed Chartered Market Technician level 1 and level 2. I plan on completing level 3 before I graduate next year. I love technical analysis. I've been trading for almost 4 years now, and I've been trading options for 4 years now as well. I started really digging deep into options trading and technical analysis before the pandemic. The pandemic kind of locked me in a room with my computer and made me kind of dig more into the art of options trading and analyzing the markets. So what kind of got me early? What kind of piqued my interest in options early? Well, I was following Wall Street Bets, and I saw people turning, hundreds of dollars into thousands and thousands of dollars. So I decided at 18, okay, I'm just going to make one trade, some random trade. I had no idea what BP was, and I had no idea what a call was. But I placed this trade September 12th, 2019. And actually, a few days later, there was a Saudi drone attack on the oil processing facilities. And I ended up making $70 turn to $400 in the span of a few days. So I proceeded to think that I was the king of the world. And as many people do when they start trading options, they start going into the calculator and they're like, okay, if I 5x my money every single day, I'll be a millionaire, by the end of next week. And I proceeded to lose thousands and thousands of dollars. Then I started to really dig deep into it. What are options? How to analyze markets? And I started to dig deeper into technical analysis. So this is one of my earlier trades. This was around the time of the pandemic, when it was first starting. And I was looking at a Tesla chart, and I noticed something that was in a technical analysis book. I noticed a tri-star. So here, this is a candlestick pattern that signals a reversal in the current trend. I noticed something very similar on Tesla. And I also was studying a little bit of Elliott wave theory at the time. And I noticed, I wasn't a huge fan of it, but I noticed a few different patterns like wave formation, motive wave, corrective waves. And I kind of started noticing a pivot forming over here. So I actually ended up purchasing a put right here for $1,000. And no, I was 18 at this time. This was almost 4 years ago. And I just purchased a put, and a week or two later, I ended up selling it for $5,000. So this was kind of the introduction to kind of technical analysis and options trading for me. So what got me into technical analysis? Well, I started to see how abundant technical analysis was in the markets. Here is something written by Ralph Nelson Elliott 80 years ago. And this is an ending diagonal. What he writes in his book is that an ending diagonal is present in the markets when a move has gone too far, too fast. Well, guess what happened during COVID? This is exactly what happened. This is a screenshot from Thinkorswim. And we can see, here's a direct quote from his book. An ending diagonal occurs primarily in the fifth wave position at times where the preceding move has gone too far, too fast. So that's 90 years later. And then in 2021, I noticed this rising wedge and a breakaway gap. And this was something that I was on. I believe I completed my CMT level 1 at that point. and I was reading CMT level 2, and I was getting more familiar with analyzing the stock market. And I actually texted my dad to sell all of his crypto right at this day. It proceeded to fall almost 50% over the next few months. And these are direct quotes from Technical Analysis of Financial Markets by John J. Murphy about the breakaway gap and a wedge, all indicating the start of a new trend and a trend reversal. So then I started to kind of combine these two ideas because, that options trade in the past, the put, I'm not a big fan of it now, but then again, back then, I really didn't know about what strike selection, when it should expire, how far in the money, out of the money, etc. And also what kind of trades to use. So I started to combine these. I learned more about options, multi-legs, Greeks. I started to combine options knowledge with technical analysis knowledge. And I started using verticals. And this is what the talk is going to be primarily about. So this is a screenshot from my blog. And here is a little bit of technical analysis. So over here, you see kind of a pivot point. And if you wanted to position the short strike of a vertical, and then you could position a long strike over here, you can create a credit spread where you get credit for the vertical. And we could see 4 days later, this is 4 days to expiry vertical. It would have expired over here. I mean, the price would have ended up here at expiry, and we would have made 11%. So that's just one example of using technical analysis, looking at support and resistance zones and trading them based off that. But now let's get into verticals. So let's look at the construction of verticals. So vertical is, and disclaimer, this is a call vertical spread. I prefer to trade call vertical spreads just because of the implications of implied volatility. So I'll get more into that in the next slides, but here is a bull call vertical spread, and you are purchasing the 454 strike, you are selling the 455 strike, and then this is kind of creates the formation of the vertical. Here you are paying $200 for the long strike, and you are selling, getting credit for the short strike for around $160. And then that creates the max loss profile. And then over here, the long strike is accumulating intrinsic value. And then at the point where the short strike starts to lose intrinsic value or starts to go against you, they move at the same rate. So then this this is your max profit line, which is the difference minus the spread. Okay, so over here, let's deconstruct the verticals. So day by day, how does a vertical function? So this is one of the biggest reasons why I love verticals. With regular options, if you just buy an out of the money call option, if you buy an at the money call option, over time, you lose a lot of money, even if it moves just a little bit. Now, what I like about verticals is that you could purchase them, and then you can even be wrong initially. The market could go against you. And then as long as it goes above the short strike by the time of expiry, you would actually make more money than if it just initially moved a lot past the short strike. So it's kind of more forgiving for being bad at market timing, essentially. So if you see over here, this is around a four-day expiry vertical. And over here, this is the first day that you place it. You see that this is your profit and loss diagram. And by the way, this is price on SPY, and this is your profit and loss figures. The first day so let's say it moves to where the short strike is, 455, you will make maybe 1/3 of total profit potential. Now, if you wait another day, you'll make a little bit more. And if you wait another day, you'll make a little bit more. So you could see this, you could see that you make, for example, at 456, you make already half your max profit potential versus closer to a third or a little bit above a third. And then if we look at implied volatility, we could see that here are different slices of implied volatility. So let's say the stock market is at 14% implied volatility. As it goes down, you'll see that along the area of the short strike, it starts to actually become more profitable. So this is why I love verticals for earnings plays, because generally speaking, when there's earnings, there's an implied volatility crush. And if you're even right, so a lot of times when you do earnings plays and you buy just a long option, and even if it moves in your favor, you can see that you lose 100% or 80% or 90%. And that's because of implied volatility crush. But with verticals, if you position it out like near the money, it can move 0.5% and you could be up 80% or 100% sometimes. So we can see this along slices. For example, here at this particular point, if implied volatility didn't change, you'd be up around 90%. But let's say implied volatility fell 4%, you would be up 110%. I don't know about you guys, but I prefer 110% profit over 90. So now here's how I think about verticals, like a centaur. So half human, half horse. Here it's like half long, half short an option. So if you would like the vertical to have more qualities like a long option, put it further out of the money as a net debit. If you would like it to act more as a short option, put it further out of the money as a net credit. So here you can see with the call vertical, around here is the long strike, and around here is the short strike. So you can see that this looks similar to like a long call, long option. Here it looks similar, more like a short option. We could see that in terms of theta, and we can see that in terms of vega. Generally speaking, when you are long an option, you are net negative theta. And when you are short an option, you are net negative, you are net positive theta. And same with vega. You are generally net positive vega when you are long options, and you are generally net negative vega when you are short options.
Okay, Matteo, maybe we should just paraphrase that for people who aren't too familiar with the Greeks. So a P&L is simple enough. And what you're showing here on these three charts is the leftmost one, you're showing the stock moves up and down, just the stock moves up and down. What happens to your overall equity or profit and loss? The theta means, are we making money? Are we spinning off cash or not? Is that right?
Yeah,
With time.
so theta is the relation to the value of the option over time. So if you're in a negative theta environment, so if you're on the side of the long strike, then you're going to be in a negative theta environment, which, as you guys may know, if you just buy, just one call, one put, as time goes on and the stock does not change any price, you are going to be losing money every single day. If you're on this side, on the side of the short strike, as time goes on, you'll be making essentially income off of this. So you'll be making money every single day, assuming that the stock price doesn't move.
So to even maintain to avoid continually losing cash, you want to be above the midpoint of the vertical spread. Is that right?
Yes. You want to be approximately above the midpoint.
And then vega finally refers to what happens to our position in terms of its profitability or its equity if option prices generally increase or decrease, which we can call a volatility.
Yeah. So vega is a relation to the cost of the option and how much it moves up or down, depending on how much implied volatility moves up or down. So along the side of the long strike, if implied volatility goes up, you profit or you make more money. And then on the side of the short strike, if implied volatility goes down, you make money.
And to simplify the notion of implied volatility, we can say it's option pricing generally. In other words, are all the prices going up, then that's increasing volatility. Are they all going down, then that's decrease in implied volatility.
Yes. Yep.
Oh, thank you.
Okay, so so this is, again, like I mentioned, earnings play. This is why these are perfect for binary events, such as earnings play. The decompression of implied volatility followed after earnings call can impact us in a positive way, assuming price action reaches and exceeds the short strike. This can be done with a 1-to-1, 2-to-1, and 4-to-1 vertical. Now, this is an idea that I made up. This is something that I wrote about in my blog. I'm sure it's been written elsewhere. I could not find it anywhere. So if someone can link that, I would appreciate that. But this just makes sense to me to refer to different verticals like these. And I'll get back to that later. But here is kind of a direct representation of the effect of vega on and implied volatility as implied volatility changes. So over here, again, this is implied volatility decreasing by 2% in each slice. And this is the side of the short strike. This is the side of the long strike, and how it changes over time. Okay, so now 1-to-1, 2-to-1, 4-to-1 verticals. Here's a QR code to the blog post, the original blog post. So as I kept trading verticals, I noticed a pattern. The payout structure became increasingly advantageous as both the short and long strikes shifted further out of the money. I will put a disclaimer. I trade options directionally. It's not very popular. Not a lot of people do it, but I prefer to do it that way. So this is definitely for directional moves. It can be earnings announcements. It could be different economic statistics. It could be anything that you want. You could also position them longer term, but I prefer short to midterm. So this doesn't make sense to me because in a market about to break out, there may be a 40% chance of breakout with a 3-to-1 payout. In a trending market, there may be a 50% chance that a 2-to-1 vertical lands in the money. So here's how I classified the verticals. Here, you risk $100 to get $100. Here, you risk $66 to get, $134. Here, you risk around $40 to get $160. So I figured, okay, this is like a 1-to-1. Here, you're risking $2. Here you're risking $1 for every $2 you stand to make. Here you're risking $1 for every $4 that you stand to make, and they increasingly go out of the money, and the odds get better.
Okay, could you clarify though what you clarify again? What is a 1-to-1 or 2-to-1 or 3 or 4-to-1 vertical?
Yeah, so a 1-to-1 vertical is going to be more closer to the money, at the money. Some would say, and basically a 1-to-1 is you're risking for every $1 that you're risking, you stand to gain $1 in this vertical. For a 2-to-1 would be for every $1 that you're risking, you stand to gain $2. So for example, in an earnings play, you could set up a 2-to-1 vertical. You can risk $1,000, and then the max profit is 2,000. Max risk 1.
But how do you achieve that in the design of the vertical? Is it twice as many legs on one side?
No. It's just the position. So
Just the position within the vertical.
Yeah. So it's just like how far away the strikes are relative to the money. So it's just, you position, like, for example, as I'll get into in the next few slides, you keep the same strike width, except you just make them both go a little bit more out of the money. And with SPY, you'll see this. You'll see that you only need to move like an extra $1 for both of the long and short strikes. And then you could get like from 1-to-1 to 2-to-1 odds, so a 0.5% move or sometimes 1% move can make you double your money. And depending on the time frame, you could double it within a day, you could double it within a month, depending on your risk tolerance and your time frame.
So you're just referring to whether the middle of the spread is in the money, out of the money, or at the money?
So all of these are technically near the money to out of the money. These two are definitely out of the money. I'm kind of referring to, so like the cost of the vertical will be, let's say, if the strike width is $1, the cost, if it's 25 cents and the strike width is $1, that's a 3-to-1 vertical because you're paying 25 cents to get to $1, but that's a gain of 75 cents. So you're risking 25 cents for 75 cents. So you're risking 1 cent for every 3 cents. So it's kind of some like quick math that you do in your head as you're purchasing it, and you know the odds instantly once you buy the vertical.
And the variables are whether it's in or out of the money and the width of how far in or out of the money it is. and the width of spread?
Let me actually answer that question in the next it's 3 slides from now. I'll get to that.
Sure.
Perfect. So then ways to adjust the ratio. So there's 2 methods. So here, this is short strike is just 1, and then the cost is $50 and the max profit is 100. So over here, once again, as we saw in the slide that depicted this, you are purchasing this 452 long call, and then that costs $252 or $2.52. And over here, you're getting the credit of 1 strike above of $2.02. And that is a total net cost of 50 cents, except because the strike width is $1, that makes your max loss $50 and your max profit $50. So that creates a 1-to-1 vertical, because for every $1 at risk, you have a potential for $1 profit. And now you could adjust it in a different way. You can adjust it by increasing the short strike 2. So there's a distance, the width, the strike width is $2. And then here you are paying $2.52 for the long strike. And then you get a little bit less credit for the short strike because it's further away, but the increase is now $2. The strike width is now $2. So now it's costing you 93 cents for $2 worth of profit, or $2 total that it would be valued at. So that's a total of you're risking $93 to get $107. So that's a 1.15 to 1 vertical. For every $1 at risk, you have potential for $1.15 profit. So if that doesn't make sense, it will start to make more sense in the next slides. So method 2 just doesn't increase the strike width. It keeps the same strike width, but makes the vertical go more out of the money. So strike width 1, and as you can see here, they are side by side. So these are all strike width 1 verticals. And here, this is a 442, 443 vertical. This is 1-to-1. And then here, you just move up $1, and now it's increased the odds to 2-to-1. So this is a 443 to 440. Actually, these are strike width 2, 443 to 445. You keep the same strike width, 444 to 446. And this is a 4-to-1, I believe. So now let's see this across the options chain, and this may answer your question. So for method 1, you are increasing the strike width incrementally. So the long strike is 252, the short strike is 253. The long strike is 252, the short strike is 254. And then it's the additional cost for every $1 extra that you stand to gain. So you're essentially purchasing an extra $1 of profit potential for 43 cents if you feel like it will go to 254. You're purchasing another $1 of profit potential if you feel like it would go to 255, and so on and so forth. So here the odds increase as you keep going up. You see this across the options chain. This is the difference. Again, verticals are one option is short strike, another is long strike. So here, this is on the call side. This vertical is you're purchasing the 252 and you're selling the 452 and you're selling the 453. That costs you 50 cents. That's a difference. Here, the 453 and you're selling the 454. The difference between these two numbers, 43 cents, and you keep going. So I prefer method 2 because this just offers better odds. So if you believe that the stock will go $5, you would get 1.69 to 1 odds, but here you would get 3 to 1 odds. Here's where you keep the same width, and you just keep adjusting the short strike and long strike. So here the long strike, 252, 253, then it's 253 to 254, and then it's 254 long strike to 255 short strike, and then you keep adjusting it.
It says 454 though, or
yeah, my bad. It's a typo.
okay.
So it just replaces 2 with a 4. So 453 to 454, 454 to 455. But these numbers are the same displayed over there.
And the market is at where?
So the market would be around 252.
Okay.
Because over here, this is in the money, and this is in the money. So. And now the differences between two methods. So if you think about the proportion of net credit you'll obtain from the short strike relative to the net debit you'll pay for the long strike. Further out of the money short strike with method one may yield a very small premium, but could substantially decrease your profit potential. So is the trade-off worth it? So as you keep increasing the short strike while maintaining the same long strike, you'll get less and less premium and credit as you go up the strikes. And at some point, is it worth it selling a 20-cent super out of the money strike where you risk a lot of right tail movement? And how much are you willing to cap your gains for minimal additional credit? This goes for method one and method two. And then spread. So the spread will be approximately the same. So the bid and ask spread, but for method one, the total cost of the vertical is going to be substantially higher than the total cost of the vertical for method two. So for here, if you think about how much money you're losing up front, you may be losing, 5% on an out of the money method two vertical, but you'd only lose 1% because you're paying more money and you have more to gain with method one. And you also have to think about the price. What price do you want your break even to be at? With method one, the break even price is much more admirable and much more enticing versus method two. Method two is just going to be further out of the money. It's going to be in between the short strike and the long strike.
And can you recap what method one is and method two is?
Yeah. So method one is where you essentially increase. So you keep the same. So here you have the same long strike, but then you keep increasing the short strike out of the moneyness. So here, the spread is $1, and here's a long strike, and here's a short strike. And then here you keep this long strike, and then you increase the short strike by $1. So you consistently keep it increasing the short strike more out of the money. And then method two is where you have the same strike width, and then this just gives you better odds in general. So this is method one, where you just keep on increasing the short strike distance. And then with method two, you keep the width the same, and you just increase both of them each incrementally. So you see that the odds are a little bit different, but the
So
cost,
you keep it more centered in method two?
yeah. So with method two, for example, it would be a 255, 256 vertical. With method one, it would be a 252, 255, or a 252, 256, or a 252, 257 vertical.
Okay.
And then with method two, you would just do 253, 254, or 254, 255. And then that increases your odds substantially. So method two also goes very well with the Kelly criterion. The Kelly criterion was originally created by John Kelly, a Bell Labs scientist, in 1956. And here's the formula. So it is the decimal odds minus 1 times the probability of winning minus the probability of losing, which is 1 minus p, over the decimal odds minus 1. So here you can see that if you do use the Kelly criterion, and this is assuming positive EV, expected value, it is the optimal position sizing for these different trades. Obviously, you don't want to do less, but if you want to reduce volatility within your portfolio, do less. So this was formulated to use optimal bet sizing, and this could be used in trading systems or on your own. So here's an example. Let's say there's an earnings play, and you are choosing a 1.89 to 1 vertical, where you estimate that there's a 40% probability of the options expiring in the money. Now you apply this to the Kelly criterion, and you do 0.4 times 1.89, and this is a 40% probability, minus 1 minus 0.4 over 1.89, and that equals 8%. So let's say you have an options trading account, which has $1,000. Then this means 8%, $80 should go into this vertical. So what's next? I love to develop new options trading strategies in my free time. I just kind of do that for fun. Special thanks to Don and Mark. Mark initially told me about Don and about this group and told me to reach out to him. And yeah, I'm looking forward to meeting and getting to know all of you guys. So yeah, thank you guys.
So who else now? Have people been able to follow this? Let's have some discussion, please.
Yeah, please ask as many questions as possible. I realize that this was maybe not the best structure, but please ask any questions that you guys want.
Hey, Matteo, I think you might have an error in your last slide with your example of 1.89. If you're using the formula, it says the decimal odds -1.
Yeah. So the decimal odds, is actually, this would be 2.89. So it's including what you have at risk. So the decimal odds of a 1.89, because because you're risking 1 for every 1.89 in total, you would it would be, the decimal odds would be 2.89.
Cool.
Yeah.
So can you explain again how you would use this in trading?
Yeah. So the way that you would use this in trading, for example, with method 2, you could use these different odds based on, you could look at the expected move, or you could do your own research. You could say, okay, historically, when Tesla outperforms the market, how much does this, or when Tesla has good earnings, how much does it move? Or you could do your own analysis. I personally use technical analysis to estimate different moves. But you could say, okay, there is a 40% probability that the stock will move this certain percentage. You could look at economic statistics, upcoming releases. You could do whatever you want. And then you say, okay, there's a certain percentage that will be in the money. And then you use the vertical odds, and then you combine them, and then you get a certain percentage of your portfolio that you should put towards it.
John, are you able to understand this?
I was just thinking about the use of the word odds, and it really seems like the things you have labeled odds should be labeled payoff or payoff ratio or something.
Yeah. I'm treating it similar to that. Like, I'm using like the odds, like, I guess, terminology, or like way, like 1.8921, but it's really payout. The real odds is like the probability.
So would you, now let's say you have something like this, would you continually, you design some vertical spreads and you would use them as a primary trading vehicle or as a hedge?
Yeah, so for me personally, I trade verticals directly. So I don't really use them to hedge. I have this idea of where the market's going to go based on my own analysis. And if I'm trading bearish, I generally trade calendars. And when I trade bullish, I generally trade verticals. So I'd say, okay, over the next few days, I see that we're in an uptrend. And then I look at, a certain oscillator on a lower time frame. And then I open up a vertical trade and I say, okay, this is going to be above this price by a certain date. So then I place it. So it's more of speculation.
So now, of course, verticals are a key component of many strategies, including in particular, let's say, earnings, butterflies, or earnings, or iron condors. So would these also apply to the placement of the legs of the embedded vertical spreads within those structures?
Sorry, could you repeat your question?
You're looking at them as a standalone vehicle, but also we know that vertical spreads are the essential elements of butterflies and of also iron condors.
Yes.
So wouldn't the same kind of thing apply to those trades?
Yeah, for sure. You know, iron condors, again, there's a max payout and a max loss. So you could certainly apply, you know, this formula to them. Yeah, you definitely can. That kind of reduces your cost basis because, you know, if you're setting up a condor, like directionally, you just have a debit spread, and then you get on the other side a credit spread. So you get some net credit to offset your losses. Therefore, you could purchase more. Yeah. So you certainly could use it for that.
I mean, I saw somebody who was advocating when you have, let's say, a butterfly, and then very often you're continually adjusting the legs, and you would always try and have it such that the legs were either in the money or out of the money. If you have it in the case of a vertical spread that is at the money, like some butterflies, people have a vertical spread across the money, and it's crucially different whether you keep it in the money or out of the money, because in one case it'll continually lose value, which gets back to your theta and your vega characteristics. And so I think this is all very important stuff. And does anyone else have any comments? Does anyone else trade vertical spreads a lot or at all?
This is Dan. I trade the spreads, but usually on short side. And
what do you think of this kind of detailed analysis of the two sides of the spread?
well, I got to think about it a little bit more there to see. Like I like to put it in more probabilistic terms there to see. I wasn't didn't pick up on how far out in time are you doing it the nearest expiration.
Yeah, so I'll tell you this. I trade 1 to 4 trading days to expiry. So
Okay.
I personally trade very short time frames. Same with calendar spreads. Yeah, I prefer it. Again, like if you look at how it, you know, over time, yeah, like over here, over time, it just, I don't see the reason to open a vertical super far, like super long dated, because, you know, these are going to be even wider, and it's, you know, here it's you get to maximize the profit potential very soon, and it requires, like, you know, a quarter percent.
Yeah, with this approach and this time frame, you're almost having to sit in front of your computer and wait, watch the trade, I would say, or the fluctuations are up and down quite a bit with just a day or two to go.
Yeah. So actually, I have it set up on my computer on Thinkorswim. I probably look at a stock chart like 5 minutes a day. What I have set up is text messages that come through. So I have different indicators coded, and I have different stuff that basically I get a text and it says sell, and then I go to my phone and I sell it, you know, and then I'm done. But also I like this for volatility plays, right? Because, like, you know, this moves a little bit and then, you know, it can go back and forth, and then, you know, at some point you're over here and, you know, you could just sell for 50% profit. It's not 100%, it's not 150%, but if you're okay with like making 40%, then sell it.
Oh, that's better than trying to make the home run, get 90%.
Right.
Yeah. So are go ahead.
Hi, my name is Caesar.
Yeah.
I trade 0 DTEs, ATFs. I use EMA the 2150. And I like to look for engulfings and evening stars and rising stars.
Right.
I'd be using Fibonacci levels for the 0% turnarounds on the 0 DTs. That's pretty much what I do.
Yeah, that's awesome. And you know, those are examples of, you know, people who, you know, I mean, is that let's see, you trade Fibonacci levels, you do all that.
Yes,
Yeah,
I use the Fibonacci levels. I weigh into it passes like the 50% or
right.
it doesn't pass at the 50%. I decide if I'm going with a iron condor or sometimes I use butterflies and I play with the middle leg. So if it's moving down, I raise the leg up, or
Right.
if it's moving up,
And
I raise.
okay. And did you say CBOT?
Zero DT. That means same day
Zero.
trading. I buy and sell on the same day.
Oh, I see. Okay, very good. Well, it's
I
good to
also
hear.
like the verticals a lot too. I like the verticals because I like to get credit for the verticals when the turnaround happens.
They're a great way of adjusting your Greeks too, aren't they?
Yeah. No, they're great for that. You know, as you can see over here, like you could be, you know, negative vega and you could be positive theta at some points. So
No matter what trade you're on, like whether it's a butterfly or an iron condor or whatever, if you don't like the Greeks, if it's become too negative delta or too positive delta, then you just add an iron or a vertical spread. There's some questions in the chat. Have you seen them?
let me look. Okay, let's see. What to's okay. Further out, okay, let's see. Oh, link to my blog. Oh, awesome. Thank you guys. Yeah, honestly, and honestly, my blog, like I just post there for fun. I'm just thinking about this all the time. When I wake up, when I go to sleep, sometimes, you know, I'll wake up in the middle of the night, have a trade idea and be like, all right, you know, I'm gonna write that down. So I just use the blog just to, you know, but let's see, how do we send over the next meeting event?
Can we read the question too, so people who?
Yeah. Okay. Yeah. The further out of the money, the lower the probability, but a higher rate of return ratio. Yes. Matteo, what tools do you use to select positive EV trades? So what I use, so this is gonna sound kind of crazy, right? Because it's not really. I guess it is pretty standard, but what I like to do is I like to do mean reversion trend strategies. So basically what that means is like, it's very simple. So I kind of identify the prevailing trend. And then from there, I like to use lower time frames, various oscillators to determine when it's oversold and overbought. So for the past few, besides today, actually, I opened up a bearish calendar spread 2 days ago. But for the past few weeks, I've been just purchasing a bunch of call verticals because the overall trend, as you see, is just up. So anytime there's a down day, like for example, there was a huge red down day. I don't know if you guys remember a few days ago, and I just bought a ton of verticals. And the next day it was up 1.5%, the markets. So in general, I believe a market that's trending is going to it's more likely to continue the trend than not. So if you just look, kind of do a top-down analysis, right? Look at the overall market trend and then go down and look at different oscillations within that, then I feel like that's a great time for verticals.
This is what people should be doing if they're just starting trading and they want to trade some spreads. They should trade verticals according to whatever their market analysis is.
Right. Yeah, and if you're in an oversold position in the market, then you just open one up, like literally $1 or $half out of the money. And I mean, the market moves like, what is the ATR on average of SPY? It's like $3, $4. So the market just swings constantly, and you could just close it at any point. So it could also just be a volatility trade. ATR is just a way to measure kind of daily volume. It's a technical analysis way.
Average true range.
Yep, average true range. So yeah, so I basically just long story short, I like to see what the overall trend is on a larger time scale, and then on a shorter time scale, I like to use different oscillators depending on what the current trend is.
Okay, and no more questions there.
You can use the delta of the short call strike. Okay. I don't know if there's any other.
Gary says, could you set up an actual vertical spread using this analysis? Like give an actual example using the stock and strike prices.
Yes. Let's see. Let me see if I can. Yeah, and the ratios are, I mean, it's not going to be perfect, like, 1, 2 to 1, 3 to 1, but you could get it pretty close. So let me.
Yeah, that would be very interesting to see that if you can do that.
Yeah, for sure. And also the indicator that I use that I get text messages every day with, that's something that I coded myself on Thinkorswim, but you guys, like, I know there's like thousands of different indicators on Thinkorswim that you could easily just be like, okay, send me a text message whenever some sort of condition was met. Apologies, it's taking a long time to load, but before I get this open, does anyone, are there any other questions I could answer?
Well, Bruce is asking what triggers you to sell in terms of when do you take profits or take losses?
Yeah, so I'm a big fan of so I like to take profits kind of like the day that it expires usually, if I'm in the money, because I just think, okay, like gamma is very high, and there's like a lot of risk. And, if I'm already up 80%, 90% on a 1-to-1 vertical, might as well just take profits. Some other times, I open up a vertical, and if it shoots up pretty fast and it goes past the short strike, even if I'm up like 30%, 40%, I'll just take profit because I'm like, okay, no one went broke taking a profit, so why not? So it's usually half the time it's because it passes a short strike, and I'm just like, okay, you know what? I've made some money. I'm good. Or it's because it's the last day, and like gamma might screw me over. So I'd rather not take the risk. I'd rather take 90% profit and not risk, that off chance that I lose not just my gains, but the entire money put forward up front. So those are two things. Okay. So let me get it set up, and I'll share my screen. And also, I will say that I do not trade on Thinkorswim. I trade on Webull, but I use Thinkorswim because it is an amazing platform. But let me. How do I do this? Okay. Share screen.
Does Webull allow you to execute at the mid price? I've never used it.
Yeah, Webull. I mean, for me, I'm not entirely sure. I trade like only SPY pretty much, like 90% of my trades are SPY. So, you could see that it's very, very tight spread. So for me, like, I'd say yes, it does. But it really depends. I'd say in general, yes. But for here, so for this example, so here's 1 day to expiry. I mean, this is, if you want to take a shot in the dark. But let's, for here, like you could see, okay, this spread, the width is $1. The width is $1, right? And you could change that over here by going to deep and wide, 2 strike, and then vertical. And now the width is 2. But so over here, this is a 1-to-1 vertical, since it is, the strike width is 1, and then you're paying 50. So over here, if we want to go to analyze, and I apologize, I was analyzing some other ideas. So let me clear those. So over here, if we do analyze, you can see that this is a 1-to-1. And then if you wanted to go over here, this is going to be closer, 30. So this is going to be closer to a 2-to-1. So if you want to kind of compare them, you could see that. Let me go to here, single. Let's do. Yeah, so you could see kind of what I was talking about. So over here, you're paying only 30, and then you can make 70, 71. And then over here, this is a 1-to-1, and then this is cost 50, and then you have the possibility to make 50.
Where do you see those numbers that you're mentioning? Like starting with 1-to-1, where do you see that it's 1-to-1?
Yeah. So over here, it's kind of like a little bit of mental math. So for example, here, the strike width is $1.
Mhm.
So you know that this is 1-to-1 because you're going to purchase it for 50 cents. And that's half of what you'll make. So that's a half of the max profit. So the max profit is $100, and the cost is 50 cents or $50.
And is it generating that 50 cents? How is the 50 cents derived?
Oh, because sorry. So over here, you could choose the spread. So here's single, and then here's vertical. And then these pop up. This is a 50 to 51 vertical. So here, the strike width is 1. And then the 50 cents is over here. So you buy, so this is a 51, 52, you just click buy. And then you could see that in between here is around 50. So this is a 1-to-1 vertical because the strike width is $1, but you're paying 50 cents.
Hmm.
And then you can see that this is actually better than a 2-to-1, and then this is better than a 4-to-1, and then you can keep going. But just because that the max profit is $1, and then 23 cents, do $1 minus 23 cents, and then how many 23 cents go into $1 minus 23 cents? That's the first digit, and then that's to 1.
So they're just taking that leg further out of the money.
Yes, you're taking it further out of the money. And honestly, at some point, if you go so out of the money, like it's not even worth it. Like at this point, you're selling it to people who are very smart to sell these, because they basically making this for free at this point, because it's so far out of the money. If you look at the delta of that call so like 59, you look at the delta, and the delta is 8. So it's like 92% chance that doesn't land in the money. But what I like to do is I like to do closer to the money. I like to do 1-to-1, maybe 2-to-1 if I'm ambitious, just because, throughout the day, it's going to go back and forth. It's going to oscillate, and there's more opportunity to leave. And then, hey, if tomorrow it stays at the same price, well, guess what? My payout profile just got even better because of what we saw over time. The payout gets better.
Matteo, would you say
Uh-huh.
that you're coming into these trades with a presupposition that price may move a certain percentage, and you're looking for the vertical that fits that percentage move with the most upside? Or I'm trying to associate or disassociate your picking of the vertical with or from your hypothesis of the market.
Yeah. So from my hypothesis of the market, let's see. I guess I don't have. This was for the most recent post. Let me see if I could clear these. Sorry, it's getting very laggy. Clear drawing set. Yep. Okay, so like here, for example, so this is a unique case because we have another breakaway gap. So I'm not gonna touch this candlestick. But for example, like let's say, you know, we're in a market, you know, that's so for me, like, I mean, it's kind of hard to like show an example from the past because we all, like, you know, hindsight is 2020. But like let's say over here, like, you know, I wanted to place a vertical. Actually, I would not do it in a downtrending market because implied volatility, as we saw, if you do it to the put side, it would minimize max profit. But like here, you know, let's say you think that there's going to be a breakout. Then what you could do is kind of like, you know, be like, okay, from here, you know, if it broke out over the next few days, it could go to, you know, 390. And then of course you could do various techniques. Like, for example, one that I used to like to do in the past a lot is, where is it? You could do various like time ratios. No, not time ratios. I have not touched this in a bit. You could do like here, like different, you know, time series to be like, okay, so from this low to this high, it took this many days. And that's about, you know, this much price movement. So over the next same amount of days, if I believe that it will have a similar price movement, okay, I could get a 3-to-1 vertical over here, or 2-to-1 vertical. And then, you know, if it hits like the moment that it goes past a short strike, I lock in profits. So you could do stuff like that. But personally, like, it's also very good for like volatile markets. So over here, you know, you see that it's kind of range bound. You could just purchase vertical calls over here. And then, like, let's say over here, right, you see you could see some support along 378. So at 378, you could just purchase like a 380 to 382 vertical. And then you see that, okay, like it constantly moves around over here. Even at this point, even though it's like such a small move, you could be up 200% just because, you know, you notice that, okay, there was this kind of range bound market.
So we're assuming these are all bullish trades. Is that right?
Yeah. So over here, like, for example, this is range bound market. And this is very poor example, but it's just on the spot. Like over here, you'd be like, okay, you know, there's a support over here. We saw, you know, the market kind of pick up. So over here, I'm going to place a bullish trade, and it could be a 380, and I'm going to highlight this in green. So you could do long 380, and then you could do short 382 call. And this might highlight the other one, but so short, so long and then short, and then this could be like a 2-to-1 vertical. So over the next 4 days, if it goes above, and something else that I like about the 2-to-1 verticals is that gamma is better than a 1-to-1 vertical. So over here, you'd actually maybe make 100% even the next day, right? As opposed to a 1-to-1 vertical, you'd be up 50%. And then you could just sell it right then and there. So there are different ways to use this. But I have a few different methods, but this is one.
But would these all be bull spreads, or would you ever trade a bear spread?
No, I would never trade a bear spread. I prefer bull spreads. these implied volatility. And if I want to go bearish, I generally trade calendars or just long.
Ah, okay.
But I love calendars just because of if you look at a graph of vega on it, then you'd be able to see that why I love it so much. So it's generally vega positive.
Yeah, because the put is going to go way up in value when or the long side is going to go way up in value when volatility, when it market drops.
Yeah, for example, let's take a vertical spread over here, and let's say you're purchasing this vertical spread, and let's clear out all of those. This is really fast. So here is a vertical spread. You could see that as implied volatility goes up, which it generally does in a down when the market's falling. Here, let's make implied volatility go up, and you can see that it slowly increases. You see that because
so that's a good choice on a just shows how asymmetric or asymmetric trading is.
Yeah. So for me, like I generally would never trade a calendar to the upside, because if you look at it, if it's over here, and implied volatility goes down, you could see how, hey, you were fooled. When you saw this original P&L graph, you're like, oh, look, I'm going to make like over 100%. And then, volatility goes down. I mean, you see the VIX has just been going lower and lower, and now it's actually much worse. So I guess in a sense, I'm playing volatility as well.
Yeah, absolutely.
But yeah, that's why I prefer, generally speaking, I have these laws to live by. If I feel like the market's going to go in a steady uptrend or it can blast off, but a steady uptrend, I trade verticals, generally 1-to-1, maybe 2-to-1. And then if I feel like the market's going to go down a little bit, like just a little bit, I generally trade calendar spreads. So I like to think of calendars as time verticals, because if you kind of turn your side and then you look at the options chain, you can kind of see how, it looks very similar to a vertical, but just over time. And then also similar to a vertical. Let's see.
No, you're right. I can see that right off.
Yeah, it's a time vertical, and honestly, I just think yeah. Yep.
Sure.
And then it's also theta positive.
I have a quick question for Matteo.
Yeah.
Sometimes when I'm setting up, I don't know if you're familiar with a lot with butterflies, but sometimes when I'm setting up the butterfly and I put in the analysis, and the analysis tells me most likely what the max profit could be if I do execute the trade. When I execute the trade and it ends in max profit, the chart, it doesn't really give you what is supposed to be the max profit.
So your question is max profit as projected by the analysis tool too optimistic for butterflies? I think the answer is yes, because
in general, yeah, go ahead.
no, you go ahead.
Oh, so in general, I'd say yes for these kind of V-like structures. So I apologize. I'm sure there's a term for it. But for like these V-like structures, right, where it's like, okay, they both have to expire at this point. Like that's just kind of, this is just like, okay, no, it's not going to expire at that point. Like you have to think, okay, it's probably going to expire somewhere around here if you're lucky, And also, are you talking about like at the day of expiration? You like can you elaborate a little bit more? Like, are you just like you look at it and you're not up that much?
Well, since I do 0 DTEs, I really get it at the yes, max profit expiry day. But it doesn't really give you what the max profit should be, or close to what the max profit should be.
No, it can't, because that's just a point estimate. The only way this triangle gets narrower and narrower and narrower as you get to expiration. And the probability that you'll be at that max point, it becomes vanishingly small, approaching zero.
Yeah.
Okay. Yeah, that will make sense.
Yeah, and also I'll tell you, I personally don't trade butterflies. I prefer condors, just because of that reason. It's just like this is really unobtainable. It's very low likelihood of achieving that. Most likely, because I mean, even look at like the day before, like it's just, you know.
But
It's-
Gary has, yeah, we better
Okay,
get
thank
back
you,
to,
guys.
okay, sure. We better get back to Gary because he says, I don't seem to get it. So maybe let me try and explain it
Yeah, sure.
briefly, and then you can tell me if that's correct or not. But basically what we're doing is these are all bullish trades. They're a vertical trade that he's placing bullishly in the market. All he's talking about is how far in or out of the money the two sides are, because that gives you the cost of the two respective sides, the long and the short. And he gives you his ratio, whether it be 3 or 2 or 1. And he's saying place it either, above or at the money or below the money at a particular point to optimize the result, depending on whether the risk of the short side and the profit potential of the long side. Is that roughly correct?
Yeah.
Does that help, Bruce? Or Gary, I'm sorry. Okay, and just moving on. Well, there's a question. How is Webull for SPX commissions? Do they have the extra CBOE fee that you see on SPX?
I trade SPY. I don't trade SPX. But I like their fees. They actually were kind of, they had free options, but suddenly it kind of snuck in that now they charge fees. But I still feel like it's better than TD Ameritrade's fee, because I know TD is like 65 cents. But what I find is that verticals on there are like 25 cents or like 12 cents. Some options. So
Well, see, the problem with SPY though is that it's small, very small contract, right? But as long as there's no commission, then that's a plus, because you don't have to pay the CBOE fee.
right. There are a little bit. There is a little bit of a commission that I
Okay.
pay. It's not too much.
You want to feel free to answer any of the other questions, but if you could read them when you answer them, so it's good for people who don't have the transcript.
Yeah, sorry. Okay, in the chat, do you pick your DTE for bullish vertical options also based on technical analysis? You know what? That's a great question. Do I pick my DTE based on technical analysis? I do that with calendars more than verticals. Although I will say with verticals, I generally stay on like the conservative side, so like 4 days to expiry, because I'll tell you, like, I'd say like 50 to 60% of the time they go in the money the next day. So for me, like, I do trade it, but I like to be very conservative, because listen, if I did it like 1 day to expiry and it did not move at all, or like it moved more out of the money, then I would be more screwed. So I like to give myself a buffer. So I'd say kind of yes, but also like no. Just because I prefer a little bit extra time, just so then I could kind of sit on it and think and like let it kind of form to its max profit potential. So I guess I guess the answer is no. And occasionally, if I feel like the market's way oversold on a day, you could open up 0 DTE verticals. Although honestly, at that point, I'd say just open up just a long contract 0 DTE, because short strike may not do too well for you. Yeah, thank you for pulling up the options fees. I'm not 100% sure on the specifics, but index we will.
So Kieran has posted the fees.
How many days apart are sorry, go ahead.
No, you're right.
How many days apart are the time spreads in a down market? I mean, you can control it in whatever way, you like. I like to think of those similar to ratios in terms of verticals, and hey, I may be invited back to give a presentation on that. But for me, like I like to think about it, okay, kind of like verticals, right? The more out of the money, the more closer to the present that it is, the less credit that you're going to get for the short strike. So, and then the more that you push it back closer to your long strike, the more that the cheaper that the overall contract becomes. So I like to do it kind of like half and half. So I like to take advantage of that time decay, but also not have it too close to the month that, or to the week or day that you have your long strike, because then that may, if you have it too close, then if the market moves pretty fast, you may not be able to capitalize on that gain, versus if you have it kind of closer. And also I prefer the time decay as it's kind of closer. So like, let's say I open up an 8 DTE calendar, I'll make the short strike 4 DTE. Yeah, and this allows me to kind of be more positive vega as well.
Okay, it was John that John has posted the option fees for SPX, which do show they do have to pay the exchange proprietary fee, which is the same as everybody else, around 60 cents for SPX, but you're trading SPY.
Yeah. Yeah. So
Okay. Yeah, go ahead.
So SPY, I mean, what I remember, like whenever I make those trades, I see like a little disclaimer. Okay, you're paying whatever. From my memory, don't quote me on this, but for long options, it's 12 cents, and for verticals, it's 24 cents. So, you could adjust the strike width, and you could make, adjustments, but on a 1-to-1 in this example for $50, you stand to make $50 minus 24 cents. Real-time question, based on days like today's market activity, how have you looked at opportunities given you like 4 days out? So today's, okay, so this was actually a very interesting market. I'll tell you this. So actually, I actually bought a calendar spread around here. This is why, honestly, I love calendar spreads, and this is so I purchased a calendar spread over here, actually a 453 calendar spread, and the short strike expired over here. So I was left with long strikes expiring today. So wait, sorry, what was the question? So in today's market, what would I do? So for me personally, I would buy more further out, because a lot of times, these markets, like it may look very crazy right now. But oftentimes it may just like set a little bit of a trap for you, because a lot of people are purchasing puts now, right? So then, the market goes up, and then a lot of people sell it, and they're like, oh, whatever. And then the moment that everybody's like, oh, it's done, we're out, it's recession canceled, then it starts to form its other leg, right? So it's all based on market psychology. So in this instance, I think definitely, and again, this is not financial advice, but because I officially sold the long strikes today of the calendar, but today, like, you could position it for like around 448 or even 446. And then, that if it's going to fall, implied volatility is going to go higher, right? And then you could position it to where it's maybe like 2 or 3 days, the short strike, and then maybe 8 days, the long strike. But it really depends on your risk tolerance and how you prefer to manage these and trade these. Yeah, and of course, you could always like, sometimes what I like to do is I like to kind of play with them and treat it like, a version of like poor man's covered calls. So, you could purchase it, and then let's say the market remains like in a consolidation period, like over here, right? And then like it's down here, you could just, once the short strike expires, then you could sell another short strike, right? And then you could get even more credit. So you could kind of offset your losses even if it's even in a stagnant market. I could go more in depth in the calendars. I don't want to use your guys' time, and I'm sure that's discussion for another time. I could go more in depth, but that's kind of like an idea of how to trade them. Maybe like
Yeah, no, that's great.
maybe for example, like wait for tomorrow's like up market, maybe we'll go up a little bit. Then that's when, you could position it. Again, this is not financial advice, but it's kind of like the way to think about it is like, okay, what's the best placement for these? Because for me, like I bought the calendar around here on this update because I was like, okay, this general trend is like, it's like this. And right now, here, if I bought a calendar for a few days out, like, okay, over the next few days, I kind of had some bearish inclination. So I felt like it was not very risky to open that. But yeah, it's depending on your inclination, because even here, you can make the case for, hey, look, at a down day, you could just buy a vertical that's like a 450, 451 vertical. And next day, if it opens up over here, you're already up 50%. You could sell it, you just spent 1 minute in the market, done, go enjoy the rest of your day. So it all depends on how you want to trade it.
Okay, well, I mean, feel free to answer one or two more questions and if you wish, and then we can't take any more, I think, beyond what's there. But there are a couple.
Okay. So Robert, honestly, here's why vertical spreads. Honestly, I only trade on like the top 10 most liquid options chains, because if you think about it, like look, the bid and ask spread of a normal option, like here, it's like 3, and then here it's like, so verticals, it's far worse. So like here, you see that the spread, this is like you're basically minus 10% once you initially take this trade. Okay. I mean, if you get around mid pace, maybe it's like minus 5%. But if you look at like other stocks, like someone just shout out a stock, like maybe just like, BP. If you look at like verticals here, you'll see that the spread is absolutely atrocious. So for me, like that's why I mainly trade SPY, because I know that I'm getting the best fill. Same with like the spread will eat you alive. I actually have a custom function that tells me how much money I'm losing every time I place an options trade. It's basically that like ask minus bid over the total price that you're paying for the options contract. I highly recommend you guys you incorporate that, because then you could see, okay, how much am I losing upon each trade? Because you may be losing money the second that you purchase the vertical. Like over here, you're already 50%. So that's why you have to like also, as I said with method 1, right over here, right, you're losing whatever 5%. But then if you adjust it to, let's say, 3 strikes, well, guess what? The spread is still 4 cents, but now it's not 5% of all of this. It's like 2%, and you could adjust it even more, right? You could make it like, 5, you could adjust it any way that you want to reduce the initial loss that you're getting upon placing the trade. So that's something else to consider.
Okay.
So that's why I trade like this in QQQ, for example. Have you traded SPX and NDX? Honestly, I don't trade SPX and NDX. So I don't know. Do you have any comment on that?
I mean, that's great that the idea, I mean, SPX is going to take a lot more margin. So it's for larger traders.
Right.
Well,
Yeah.
SPX and NDF is very liquid.
Yes, they are. But so is SPY.
Right.
Yeah, SPY is incredibly liquid. I believe I remember seeing the stats a week or two ago. Is like on average, like the daily volume is like 8 million in options in SPY versus this number 2 is like QQQ with like 2 million. So SPY needs everything by a huge margin, and that's why you could see that the spreads are actually very, very good.
Well, I think we better watch the time, unless there's anything you want to add. I mean, it's been a fantastic evening for both talks. I think and Matteo giving an idea of how to really get into some of the details of trading of spreads, which is a vertical spread, which is a very simple trade. And people are going to have to experiment with that and get familiar with that and trade it. Even just the mechanics, as you say, the spread between the bid ask, everything else is something people need to get used to. So unless anyone has any final comments, did you have any final comments, Matteo?
No, I'm excited. I mean, I live in Raleigh. I'm in NC State, so I look forward to future in-person meetings. This is my first meeting and the first presentation. Hopefully I be invited back and give more. And I look forward to meeting you guys. And yeah, thank you.
No, you'll definitely have to do that for both of our speakers, and we look forward to their future presentations. And anybody else, unless there's any final, we got some people, thank you very much for the thank yous in the transcript or the chat. We would like to do some in-person meetings. If anyone has any locations in downtown Raleigh, please let us know, because the library is no longer hosting them for third-party groups. Please email me if you have any idea for a location to start doing some in-person meetings. Other than that, stop the recording.